Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now for a look at markets in the Asia Pacific and globally is Jamie Cox, managing partner at Harris Financial Group. Jamie, thanks very much. So I was characterizing the CPI report as, offering some positives to the market. And the Fed meeting, well, I suppose you could take that either way. One rate cut penciled in this year instead of 3, and then one more next year still means that for the next 18 months, a year and a half, Fed policymakers are expecting one fewer rate cut than what the market is thinking. Yet the markets were buoyant. So just your thoughts on the current environment.
Well, I mean, this is the third consecutive session that you've seen, all-time highs for the S&P 500. Markets don't need rate cuts. That's the bottom line. I mean, we're sitting in a situation. Yeah, I really believe that it's that investors are begging for the wrong thing when they're asking for the Fed to cut rates. Historically, the time between the last increase in the Fed funds rate and the first decrease in the Fed funds rate sometime later is when the markets are strongest. And the majority of the return during that period is front loaded. So investors need to be careful what they wish for when they're talking about rates. If rates are pushed into the future, it's actually very, very positive for stocks. It's actually the Goldilocks scenario in markets. So I believe that most people will be happy for the Fed to be, a little bit more sanguine in their need to cut rates quickly.
So Goldilocks and no bears lurking around the corner. Is that the way you see it now, Jamie?
Well, it's really interesting. I mean, we're sitting at a very similar time to the mid-90s where you have this massive productivity wave that is yet to be realized. You're seeing, massive infrastructure investment, the likes we haven't seen in such a long time, try to, build out the AI infrastructure. We have not yet seen the benefits of it. We've only seen the beginning of the investment component, and that's going to be very negative for inflation in the future. So I think markets are looking beyond the temporary factors that have, kept the last mile of inflation from coming down to the target for the Fed, and looking into the future and saying, gosh, there's some really positive things that are happening in tech and energy and industrials. This is a really good time to invest. And, there's a lot of people who are afraid and they think markets aren't good. And it's just not true. I mean, people aren't paying attention to all of the benefits and all the earnings and all the money that's being made. And now what's interesting to me, I work with a lot of retired people, and for the first time in a long time, people's retirements are a lot more secure now because they can actually earn respectable fixed income rates on their investments. It's the irony is not lost on me on how much better things are when rates are higher.
Doug, you listen to me every day. This guy's in my head. This is what I've been talking about. I mean, I couldn't agree more. Who cares what I think, but we do care what you think, Jamie. And I know that you're sort of big on the broadening theme. And I was just having a look a little bit earlier this morning. The S&P 500 is up about 24% over the past 12 months. And the equal weight S&P is up 16%. Now, that's not as much, but it's not bad.
No, it's actually good. I'm actually glad because it's been way worse than that over the past couple of years. I mean, you've had, the top tech stocks, which are consistently bringing the average higher, but you're starting to see the rest of the field catch up. And last year, financials were a gigantic drag on the equal weight S&P. That seems to be turning around some. And you're also seeing some of the other areas like utilities and things like start to get some life behind them. So the broadening out of the sector weightings, I think, is very positive. It's been talked about, but never happened. And I believe it's happening in earnest now. And there's a lot of people who have diversified portfolios who have really been kicking themselves for not having it all in the NASDAQ or in the Qs are finally going to benefit from that diversification. So here to them.
Yeah, I'm wondering whether we can't make the same statement about being overly diverse in geographically when it comes to equity markets around the world. Proof, kind of the data points that Brian just mentioned, that maybe you really needed to be overly exposed to the U.S. through this period.
Yeah, that is for sure. There is no question that the U.S. markets have dominated everything, and I don't think that's going to change. I mean, there are some divergence, in central bank policy that may change the dynamic a little bit. But when everything is so tech dominant, there's really no other part of the world that can compete. And that's just the bottom line. And as long as that persists, I think that's the way it's going to be. Unless there's a major turnover in tech, I think that U.S. markets will remain the leader, period, in the discussion. So
that said, the TAIEX in Taiwan is up 16% year to date. That's more than the S&P's 13%, and also the Nikkei in yen terms is up 16%, but it's only up 4% in dollar terms. But that's kind of the crux of the problem, isn't it? The dollar's been so strong that it's kind of pummeled a lot of foreign markets.
Yeah, it's been difficult to be a U.S. investor and devote some of your capital overseas. That is definitely, the currency translation is in your way. But that doesn't mean that there aren't plenty of opportunities. It has been such a long time since international markets dominated. At some point, the pendulum will switch, but I don't think that's anytime soon. I think that it's very much a sector-specific story, perhaps in Taiwan, but I don't think that you're going to see much change, not for a while. The U.S. is so dominant from a consumption point of view, it's really difficult to change the narrative there.
All right, Jamie, thanks very much for joining us here live on the program. Enjoyed the chat. We'll get you back again. Jamie Cox, managing partner at Harris Financial Group.
Well, after the bell here in the U.S., Broadcom reported quarterly results and gave an annual forecast, both topping estimates. This is a reflection of robust demand for artificial intelligence products. We have a bit more from Bloomberg's Charlie Pellet.
Broadcom is a chip supplier to Apple and other big tech companies. It said sales in the full fiscal year, which runs through October, will be about $51 billion. Analysts had projected about $50.6 billion. The race to build artificial intelligence systems has benefited semiconductor companies like Broadcom, even though they don't sell the highly prized AI chips that are made by NVIDIA. In New York, Charlie Pellet, Bloomberg Radio.
And the stock jumped almost 15% in late trading. Joining us for more on Broadcom is Kunjan Sobhani, senior semiconductor analyst for Bloomberg Intelligence. Kunjan, thanks very much for coming in. So we had a revenue beat and a profit beat, and then we also had a forecast beat, but these were not really massive beats. There is this stock split, but it's a little tricky trying to figure out what drove the stock up nearly 15% in late trading. So I'll put that question to you. What did?
Yeah, so I mean, the short answer is everything that investors and as analysts were looking and hoping for during the call sort of came in line. There were three things going into call. We wanted to see an upside to the AI numbers, which did happen. Actually significant upside to the AI specific numbers, even though on a total revenue, as you said, it was not a big upside. Second, we wanted to look at better or upside to the VMware numbers, both for the quarter and the outlook, which did happen. VMware numbers came better than what the street estimated, and the outlook looks again better, both in terms of revenue growth as well as the cost cutting and the integration part of it. And third, we wanted to see a sort of a confirmed bottom and a clarity of recovery in its non-AI cyclical business, which again did happen. Most of its non-AI cyclical business, the company said Q2 will be the bottom, except for broadband, which will continue to persist weakness.
Kunjan, semiconductor is such a broad category. We talk about the AI accelerators when we talk about NVIDIA. We talk about the memory chips, companies like Micron and Samsung, SK Hynix. Help me understand the products that Broadcom is involved in manufacturing and how that fits into the overall chip ecosystem.
Yeah, so Broadcom has many semiconductor businesses, but for this, I'll stick to the AI portion. So it has two major products when it comes to AI. One is the accelerators, which is the ASIC accelerators that it only sells to these large cloud providers and hyperscalers like Google and Facebook. And this is sort of an alternative to the merchant GPU silicon that NVIDIA and AMD sell. So there's a portion of that market where Broadcom is the leader actually and the number one and has majority share in that market. Other than that, in AI, they sell a lot of networking and connectivity chips. So you need to connect all of these memories and GPUs on networks and optics. So there's a lot of chips and components involved here that Broadcom sort of supports that ecosystem.
Yeah, it's a very complex and big company. There's a big software component too, and one of the reasons that maybe Broadcom stock had lagged a little bit over the past quarter, and I say that because a week ago the stock was at about $1,300 and change, and it had gotten to over $1,400 way back when it announced earnings a quarter ago. Hasn't done all that much, and that coincided with a lot of selling in software companies. I mean, software has struggled quite a lot. And if you look at Broadcom's mix, you talked about the semiconductors. I think they run about 60, 70%. You've got 20% in VMware and another 10 or 15% in software. So maybe a little bit of relief from investors today that, the software portion was okay.
Yeah, you're definitely on spot. And one of the concerns with this VMware deal is they're largest and a bit different than the typical software assets that they've acquired in the past, where they only focus on a select few large customers, but VMware has hundreds of thousands of customers. So exactly put right, the costs are coming down better than what they had laid out, and the revenue growth is not being impacted as some had worried. So a relief over there that the software piece is still doing fine.
Kunjan, when you look at the overall industry right now, so much of this, as we've been discussing, revolves around the AI trade. Are you seeing signs of any type of a slowdown in demand, or are things still firing on all cylinders?
From our perspective, for the pure play AI chip makers, not the ones, not the wannabes, but the ones who are currently selling, don't see any slowdown. One proof point of that is if you look at all the biggest US hyperscalers and cloud service providers, they in aggregate have raised their CapEx spending for 2024 by 40% over 23 levels, which were already at sky high. So as long as those guys don't pause or slow down spending, the AI chip pure play names should be fine because those are the ones they are spending the most money on.
It's kind of funny. I was just looking inside the Kospi here for some of the gains this morning. And, you can imagine after the Broadcom print and the reaction to it, information technology is up 2.5%. But it's not the biggest gainer. What's the biggest gainer? Utilities. So, that's kind of tied now. Utilities and power producers are sort of tied to the AI trade. A lot of people exposed to this. So my question to you, Kunjan, is what's the most important thing to watch for? Is it a warning from NVIDIA? When NVIDIA finally does say, warn on revenue, is that the time, up until that time you're okay, but then look out?
Yeah, I think NVIDIA could be definitely a good bogey. So if NVIDIA says any concerning comments, that's definitely a big signal, given that they have about more than 90% share there. Another good proxy point could be, again, the CapEx spending from the large 4 or 5 cloud providers and hyperscalers. If they come out and say that they're reducing their CapEx spend for 2025, that could be, say, another concern.
You mentioned the wannabes, and I'd like you to expand on that. The companies that are aspiring to rise to the level of NVIDIA, maybe they've got a heavy lift ahead of them. But the R&D spending that would be required to engineer a chip as sophisticated as some of the AI accelerators that NVIDIA manufactures. Can you imagine a world where a company rivals NVIDIA at some point?
I mean, you could never say never. We have a good precedent from Intel, at one point the largest semiconductor company by revenue, by unit sales, etc. And we used to, I've covered this. I've been in this industry for 20 years. I used to think of like nobody could ever overtake Intel, right? But it did happen. So you can never say never. But yes, you're right. I mean, at this point, you're talking about tens, if not in 50s, billions of dollars of R&D to catch up to NVIDIA. So it's really that NVIDIA has to misstep itself or hit itself in the foot to get someone else ahead of them.
All right. Kunjan, thanks so much for joining us. Some great information there. Kunjan Sobhani, Senior Semiconductor Analyst for Bloomberg Intelligence, looking at Broadcom and its earnings earlier today. Joining us here on the program is Sarah Ponczek, financial advisor at UBS Private Wealth Management. Well, let's talk about the Fed here. On the face of it, this was actually a hawkish Fed meeting, given the one rate cut this year, down from 3 in the dot plots, and also the raising of the core inflation forecast by the end of the year. But the market response was, as we know, quite positive, with the S&P 500 up almost 1%. I think many would say that that the market has confidence in disinflation and confidence in the Fed. Would you agree?
I would absolutely agree with you. I think especially if you just look at today's market action, the market would agree with you as well. Look, when it comes to the Fed meeting today, you highlighted it. Really what the big news was that dot plot. The fact that the median dot in the dot plot is now only pointing to one rate cut in 2024. But if you listen to many market watchers, strategists, you even look at what the market is pricing, what a lot of people are thinking is that, well, maybe, these Fed officials submitted their dots before this morning's inflation data, because this morning's inflation data, and you laid it out right at the top of the show, the fact that we saw CPI rise year over year by 3.4% in May. That's the slowest pace in more than 3 years. I think the Fed might be patting themselves on the back a little bit, saying, all right, we're seeing disinflation now. The market really latched onto that and said, okay, well, inflation's coming down. Sure, the Fed is saying only one cut this year, but you add it all together, what do you get? You have a market that's still pricing in 2 cuts this year. So the market is still calling the Fed's bluff there.
So maybe we can agree that the degree of easing really hasn't changed much. I mean, Brian talked about the fact that now there are more rate cuts forecast in 2025. Timeline has changed a little bit here. But in your view, Sarah, what does it mean for the market, for the equity market in particular?
Correct. So I don't think today's events really mean all that much as it pertains to change for the equity market. Sure, if we get a cut 1 quarter or 1 month later than expected before, that's not that big of a difference as long as the direction of travel remains the same. Mm-hmm. And the direction of travel for interest rates as of now still remains lower. The expectation is that the Fed's going to start cutting, whether it's at the end of 2024 or the beginning of 2025, doesn't really matter as long as they start cutting interest rates and they continue along that path. So when we look at the outlook for the equity market, we actually see reason for the stocks to potentially grind higher from here. There's a few fundamental factors there. One, of course, being the expectation that interest rates are going to come down. But behind that, really the fact of the matter being that the U.S. economy remains solid. But we have seen this modest deceleration towards a soft landing. If you look at, JOLTS data, if you look at housing data, credit card spending, ISM manufacturing data, we've seen a softening, but not to a point that would warrant a complete falling out of the economy. Rather, to a point in which we can say, all right, we're seeing the economy slow, we're seeing disinflation. That's exactly what the Federal Reserve wants, and that means that interest rates can come down over the next year or so.
Yeah, it's kind of a quirky world, though, Sarah, in that if, let's say, interest rates come down, that will actually hurt mega caps to a certain degree. And all of us, all of you listening, who have more interest in yield income than you have loans. And that's a lot of people. I mean, not all of us have a whole lot of loans, but we're all taking advantage of getting 5% yield, in short-term treasuries and in cash equivalents. So I want to put it to you that it might be one reason that higher for longer is actually a good thing for many in this economy.
For savers and retirees, it is. I mean, we have plenty of clients who
well, not just that, but think of the mega caps. They have all this cash and no loans. The mega caps themselves.
Within the tech space, yes, mega cap tech stocks are seen as quality stocks because they have extremely sturdy balance sheets. But if you think of tech as a whole and growth, there are a lot of tech companies and a lot of growth companies that still are hanging on to a lot of debt. And look, a lot of these corporations, a lot of their executives were very smart and they locked in lower interest rates years ago. But at some point in time, there is going to be this wall of debt that's coming due. And there are a lot of corporations out there that are going to have to figure out what to do if all of a sudden they have fixed debt maturing at higher interest rates. And now they have to work that into their balance sheet and revenues and profits and whatnot. So yes, you're right. Look, if you're talking about the biggest of the big mega cap tech stocks that have strong balance sheets, they're in a fine place no matter what. But at the same time, if you think about the majority of the growth space, the majority of the tech space, a lot of these companies do have debt on their balance sheet. And, if we see interest rates come down, we probably will see that as a boon to some growth stocks as well.
Yeah, and lower rates obviously going to take a lot of pressure off of some of the regional banks. We've been talking about potential stress in things like commercial real estate. Powell kind of pushed back against that notion today. He thought the financial system was doing pretty well. Let's talk about the AI trade. Brian was mentioning Broadcom earlier. This is part of the narrative that we've been discussing for months. It's the NVIDIA story, yes. It's the OpenAI, Microsoft story. Are you still feeling positive about this now?
We are. Everyone's been talking about AI now for quite some time, and it seems like there's so much hype surrounding artificial intelligence. It's the AI hype. You hear AI. All of our clients are constantly asking about it, calling, oh, am I invested in AI? How are we investing in AI? It's important, but we believe in it, even considering the gains that we've already seen. I mean, if you think about what's really fueling AI into the future, it is semiconductors, which we've seen, you just mentioned. But if you look at the stocks, the Philadelphia Semiconductor Index, this year, already year to date, it's up another 30%. So we just continue to see semiconductors move higher. But there's reason behind that. If we look at the numbers, if we look at the earnings behind what's fueling this, our chief investment office actually expects global semiconductors to deliver earnings growth of 50% this year in 2024 and another 25% in 2025. So what's amazing is that, yes, there's a lot of talk. There's a lot of high expectations here, but there's numbers behind it as well.
Yeah, especially the NVIDIA numbers. But if you look at Broadcom, the revenue and the profit beats were hardly knock it out of the park numbers, nor was the forecast. I guess there's the stock split, but it's hard to fathom a 15% jump on those numbers, don't you think?
Yeah, look, I can't speak to any one individual stock, but when you look at what's been happening at large is already there's such high expectations baked into these stock prices before these earnings reports. And what's happening is if these companies just report, they don't necessarily have to beat. They just have to meet these lofty expectations, and investors are clearly happy with that.
Okay, Sarah, thank you so much for joining us. Sarah Ponczek, financial advisor at UBS Private Wealth Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.